Welcome everyone to this presentation about the 2025 final financial playbook. We're going to talk about year-end moves that we can make and some of the year-end moves that we believe truly matter. As you know, I'm Kevin Thompson, founder, CEO of Nine Eye Capital Group, host of the Nine Innings podcast as well. And I am a CFP, which is Certified Financial Planner, retirement income certified professional, and an enrolled agent. So it gives me the latitude to talk about taxes and tax advice. I have an expertise in the retirement income certified professional circle. And of course, I'm a certified financial planner, which again gives me the latitude to speak on a variety of topics. So if you have any questions, feel free to reach out to us. We'll give you our contact information at the end of the webinar. So every December, people miss real opportunities simply because they wait until January. Most of the planning opportunities, like for example, the taxes, the giving, the retirement piece, they close off on December 31st. So this isn't about predicting markets or guessing what the Fed will do next. It's about positioning yourself before the window closes. My goal today is to help you finish 2025 strong and set you up for a strong 2026 from a place of control and clarity. So today we're going to cover six main areas today. Year-end tax strategies, moves for business owners, portfolio and retirement reviews, cash flow, debt and benefits, estate and legal updates, and finally an action checklist to wrap up the 2026 year or 2025 year, wrap it all together. And think of this as your financial playbook to close out the year with intentionality. So let's start with the concept of why year-end planning matters. Year-end deadlines drive action. Once January 1st hits, the door closes on Roth conversions, tax loss harvesting, charitable deductions. Most people plan retroactively. Most people try to plan reactively. They respond when the year is already over. Proactive planning means we can control timing, income, and strategy. Don't let the calendar make the decision on your behalf. So the Tax Cut and Jobs Act was extended this year, which means current tax brackets and rates remain in place for now, but inflation adjustments continue to move deductions and credit thresholds. This environment is stable for now, and that's exactly when planning is most valuable. You can lock in today's favorable rates before Washington decides to do something else. And we know Washington is what? It changes its mind consistently. So when we talk about Roth conversions are one of the most underutilized tools we have. If your income is temporarily lower than it was the previous year, it makes sense to convert part of your IRA while you're still in a lower tax bracket. Remember, conversions must be completed before December 31st, not just initiated. This can be a great long-term tax hedge, especially if you expect higher taxes or higher income in later years. If you're giving to charity, do it with intention. For those over 70 and a half, qualified charitable distributions, we call them QCDs in our lexicon, from your IRA count towards your RMDs and are completely tax free. For others, donor advised funds allow you to front load gifts and take a deduction now while spending or spreading out the donations over time. Always confirm your acknowledgement with letters and document everything. Remember, there's a statute of limitation that the IRS has. Make sure you document, and document. Number three, we're talking about harvesting losses. Tax loss harvesting isn't just about losing money, it's about being strategic. Selling investments at a loss to offset gains elsewhere can reduce taxable income. up to $3,000 per year. Be careful with the wash sale rule. Don't repurchase substantially identical positions within 30 days. The key is using volatility to your advantage, especially if the market decides to come down substantially. That provides us an opportunity to do a transfer or transition some of those lower cost or low, effectively lower asset values to a Roth to allow them to grow. And again, if your stock gets cut in half from $10 to $5, maybe you'll take that $5, put it over into your Roth, pay taxes on the five, and let that five grow back to 10. It's a beautiful thing. It's an excellent opportunity. Now, the tax move number four, withholding and estimates. I think this is one of the most overlooked things. We have to look at our withholdings. We don't want to get caught in a situation where, oh my God, I owe 5, 10, 15, $20,000 because I didn't have the proper withholdings at my employer. Again, the withholdings this year may give you a bigger tax benefit from the previous years because the withholding estimates were not updated. So with that being said, some of you may be getting a tax return, but again, a quick fix that gets overlooked constantly, check your withholdings, check your estimated payments. If you had a regular income this year, like bonuses, consulting work, or business revenue, adjust now to avoid penalties. Remember, the safe harbor rule pays 100% of last year's tax or 110% for higher earners to stay in compliance. Small adjustments now can combat headaches in April. We don't want the headaches. We want to make sure we have a smooth transition. There's nothing worse than having a conversation with a client with an unexpected tax liability. For the business owners have some of the best year-end levers. Section 179 and bonus depreciation let you deduct equipment and technology purchase before year end. Review your payroll. If you run an S Corp, it could directly affect your QBI deduction and timing expenses. Prepaying vendors or deferring income can help the balance sheet and your tax exposure. This is one of the, if not one of the most powerful things, especially with bonus depreciation coming back. 100% bonus depreciation coming back. There's an opportunity there for a lot of the business owners in this current tax year. Let's talk about an investment checkup. This is the time to take a hard look at what your portfolio's performance has been doing. Has your allocation drifted after this year's market moves? Are you overweight one sector? Rebalancing can lock in gains and control risk. Also, be aware of mutual fund capital gain distribution. This is one of the most overlooked things. They hit in December, it can cause a surprise tax bill, even if you have losses on that mutual fund. Compare after-tax yields, especially between treasuries and municipal bonds. It's important to have an investment professional look over these things so you don't get hit with an unfortunate surprise. Now, if you're retired or nearing it, confirm your RMDs are done. And if you don't need the money, use qualified charitable distributions instead. Look at your withdrawal strategy for next year. Sequence of returns matter when markets are volatile, especially. And if you're within 2 years of claiming Social Security, now's the time to review timing options. Every decision has ripple effects across other aspects of your financial life, whether it's IRMA, whether it's Medicare premiums, whether it's what Medicare Part A, B, or D, Medigap policies. If your Medicare premiums go up, are you? I mean, it just depends. We don't want to put you in a situation where you're now over the IRMA cap and now you're paying X amount on IRMA. We don't want to raise the amount of Social Security that's exposed for taxation. So we want to have these conversations sooner rather than later. And having these conversations allow us to offset taxes that you shouldn't be paying. Cash flow and liquidity. Cash is the oxygen of the financial plan. I like clients to maintain a minimum of 6 months, but in today's environment, I'll say 9 to 12 months. I want to have more income. I want to have enough income on my balance sheet that I don't have to worry about it, especially people that are working. I want to have more income to where I know I have 1 year's worth of expenses and or income covered in a safe environment. Revisit your debts. Can you refinance or consolidate before rates change again? Credit reports are free, so use them. Experian, TransUnion, Equifax. You can use. You get one free from each carrier, so you can use all of them in a single year. And you have idle cash. Look at T-bills or short-term CDs, safe, liquid, and earning again. I always like right now, currently, and again, it's going to change when rates come down, but money markets are a safe haven. They're getting over 3.5% at this current time, 3.85%, 4% in some areas. There's opportunities there. If you have questions about that, you can reach out to us. We also want to do a health and benefits review. This is open enrollment season. Check your HSA, your FSA balances. Use your FSA funds before they expire and max out HSA contributions if you can. They're triple tax advantage. Medicare and ACA plans should be reviewed. Plan costs and networks change yearly, of course. Benefits planning is one of the most important areas that people often neglect, and a lot of mistakes are made. I'm sure you guys are very familiar with ACA and those subsidies possibly going away. So keep your ears out, and I'll keep my ears out to the street on what's to come with that. Insurance is not a set it and forget it piece. Review life, disability, umbrella coverage annually. As income grows, so should your coverage limits. Eliminate overlap. Many people pay for multiple layers of the same protection, and update beneficiaries while you're already reviewing your documents. Education and gifting. Gifting isn't just generosity, it's strategy. You can gift up to $19,000 per person per year without filing a return. Fund a 529 plan before the year end and potential state tax deductions, depending on what state you're in, of course. And if you want to help with tuition directly, pay the school. Those payments don't count against your gift limits. So just pay the school. This is one of the most overlooked ones as well. Estate and legal documents. If it's been more than 2 years since you reviewed your estate plan, it's time. Make sure your wills, power of attorney, healthcare directives reflect your current wishes. Check titling, especially for real estate property and joint accounts. TOD, POD accounts must align with your trust and our estate. Estate documents only work if they're properly coordinated. Your trust only works if it's funded. Make sure that if you have your trust and there's nothing in it, it's just an expensive shell of piece of paper. Start having these conversations about how are we going to fund our trust. Check banking accounts, property needs to start going and getting retitled into the trust. If you have questions on that, we can walk you through it, but we are not attorneys. But we will help you, guide you through the process, but we will not give you recommendations on that because, again, we don't want to cross over into the world of law. So we have an organizational checklist. This is your year-end tune-up. Gather your W-2s, your 1099s, your donation receipts now instead of waiting. Build a one-page household balance sheet, net worth, assets, liabilities. Keep your financial data accessible and secure. You'll thank yourself when tax season starts. You'll thank yourself. And by the way, we have a document that you'll have access to. We'll send the link out to everybody. You'll have the link in your profile or in the review data, and you also have the link in this once it's on our YouTube channel to go in and get a data checklist. So here are common mistakes to avoid. Here are the big four. Waiting until January is too late. Ignoring taxable distributions creates surprise income. Overconverting to Roth and crossing to higher tax brackets, that is a killer. and failing to coordinate with your CPA or advisor. The antidote is communication and timing. Don't be late. Have more conversations. So here are the key takeaways. The three big ideas to remember. Plan before December 31st. Most opportunities vanish overnight. Small adjustments today lead to big advantages later. Taxes will change again. Be positioned, not reactive. Preparation always beats predicting. So if you don't have a year-end strategy session scheduled, this is your moment. Visit 99capitalgroup.com/year-end 2025, or you can click the link in the section in the descriptor. We'll help you. We'll identify some things that are missing, align your plan, and get you ready for 2026. The goal isn't perfection, it's progress. Let's make sure you finish strong. You'll have access to us. If you want to make an appointment, go into the down low and schedule an appointment, or you can just go to our website as well. We'll send you guys the end of year checklist. In conclusion, proactive year planning. Financial is essential for positioning individuals and businesses for strong start to the new year. By taking actionable steps before December 31st, you can maximize tax saving, optimize investments, review retirement readiness, and align your financial strategies with the evolving landscape. Remember, preparation beats prediction, and the earlier you act, the more flexibility and control you'll have over the financial future, like we just mentioned. So if you want to get started, feel free to reach out. It's Kevin Thompson. My company name is 99 Capital Group. Info@99 Capital Group. If you have any questions, you can go to any of our YouTube, Substacks, just type in @99 Cap or @MLB to CFP. Go to the website, 99 Capital Group, to schedule an appointment or ask questions. Thank you guys for listening. We'll see you again soon.